Hello, everyone. Welcome to the session of FANG, the Finance Executive Networking Group, the international session. I'm Susie Taharian, one of the steering committee members. I'm delighted about the session today. I recently joined the Band of Angels, which is one of the premier angel investing groups based here in Silicon Valley. And I invited the Band of Angels to come speak to us because I thought there might be other CFOs and finance executives who are also interested in angel investing. I think Band of Angels would be one of the great ones to learn about. I'd like to introduce our speaker. We're very fortunate to have Dr. Ron Wiseman speaking to us today. I pulled up Ron's background on LinkedIn and it's quite prolific, so I won't go through all of it. He has been on many, many boards and he has been involved with the Band of Angels for 15 more years. And he is the chairman of the software industry group for the Band of Angels. I thought it was interesting that he also went to UC Berkeley and has a bachelor's, an MBA, and a PhD. And I'll maybe have him tell us a little about those. And he's been an investor for many decades. Dr. Ron, thank you so much for joining us. I'll turn it over to you. This session is being recorded. Please stay on mute. If you have questions, put them in the chat and I'll try to bring them up when appropriate. Ron has kindly offered to share the presentation with the group, so we'll be sending that out afterwards along with the recording.
Susie, it's my pleasure to be here. And by the way, welcome to the Band of Angels. When I made the decision to join in 2006, it's one of the smartest decisions I've made. So a little bit about me. I've been an angel for 25 years. I'm chairman of the US's organization for angels, the Angel Capital Association. I'm also an advisor to one of Italy's largest venture funds, the venture fund linked to Italy's largest bank, Intesa Sanpaolo. I'm also adjunct professor of entrepreneurship in Deggendorf. And I've done work in Armenia, Australia, Belarus, Chile, Germany, you name it, over the past primarily 10 to 15 years, helping get angel ecosystems going, helping train angel groups and so forth. My own focus is in artificial intelligence, primarily for the enterprise, as well as things going on in health IT. I was an investing partner at one of the world's largest venture and private equity firms, Apex Partners, headquartered in London, for about 17 years. I've done lots of board service, lots of investing, and I was the chief marketing officer for the turnaround of the year back in 1999, right before I became an investor. In any case, I also ran much of marketing for Steve Jobs. And my background is in the Italian Renaissance. So there's no background that is too weird to become an investor. So we're going to talk a little bit about who angels are, what they do, how we evaluate risks and returns, something about how we do deals. And then if there is time, I'll talk a little bit about the chaos in recent capital markets and why that's all good news for angels. And I'll also talk about the Band of Angels, my group. So an angel investor in the US is a securities and exchange accredited investor who invests in early stage businesses, often providing the initial capital to launch and grow. Alternate names: angel, business angel, seed stage angel. My organization is closely allied with EBAN, the European Business Angel Network, which does many of the same things that we do. The basic definition of today's modern angel is someone wealthy enough to afford to lose the entire investment in the startup. And governments in both the US, the UK, and the European Union are very concerned that people don't go on the dole because they've lost all their money during via early stage investing, which is why there are tight accreditation rules. In the US, you have to have either $1 million in net worth, not counting your house, or $200,000 in individual or $300,000 in family income for the past 2 years, and the expectation is that will continue. Because it turns out that wealth is a terrible measure of sophistication when it comes to early stage investing. The SEC is looking for ways to expand the definition of accreditation to look at things like professional accomplishment, professional skills, and so forth. So that's a moving target. In terms of angels, in the past year in the US, we estimate that around $5 billion was invested by angels. There are around 500 angel groups. There are 16 million households that SEC qualify. There are about 300,000 active North American angels, either individuals or members of groups. Traditionally, most angel groups were local, but we've seen national and regional groups focused on industries like chem angels for chemistry or silicon catalyst for semiconductor. Lots of ethnic angel groups. Originally were lots of Asian ethnic groups, but now there are ethnic groups focused on Latino or Black members who are focusing on their communities. There are now lots of gender-based groups. Popular college affiliations like Harvard Business Angels, Stanford Angels, Berkeley Angel Network, and national origin angels as well. We have active groups in Silicon Valley for Canadians, for Italians, for people from Nordic countries, increasingly activity for people from Greece. And so we're finding many, many ways now to birth angels. If you look at 20-year returns across many, many studies, if you have a diversified, relatively large portfolio, the typical expectation across the portfolio is about 2.7x. We've also done some Monte Carlo simulations. Again, that's where some of these numbers come from. My group was formed in 2004. We have 250 angel group members and 16,000 investors. One of the really interesting changes in the US is that angel groups are increasingly sponsored or affiliated or birthed by regional economic development. We want to bring startups and all of the power that they create to underserved regions, particularly since the highest growth rate for employment is coming from startups, and that's been for many, many years. So why should you consider being an angel? Well, you might want to give back something to your community. You might want to expand your own network. You might want to increase your family's wealth. You may love to mentor. You may have been retired or just changed jobs and you want to stay in touch with what's going on in one of your favorite technology fields. You may feel a loyalty to your local community and want to get economic development into higher gear and therefore form an angel group or help with startup hubs. One of the hot things that we've been doing at the ACA is helping Black and Latino communities by having specialized programs to recruit angels and to train them so that they can give back directly and sponsor CEOs that they know well. And obviously, it's really fun to learn new markets. So we're seeing a lot of angel groups now focusing on things like AI. So the angel model is changing. When I became an angel, it was mostly, I've met my colleagues who were mostly retired or they exited their companies. They had a liquidity event, an IPO or a sale, and they were mostly men in their 50s or 60s. They were mostly focused on an angel group. They often brought a professional network with them in traditional fields. My organization, the Band of Angels, was originally founded by some semiconductor people from Intel who wanted to give back. But today we've got lots and lots of people, enterprise software, biotech, medicine, and lots of lawyers. Now this is quite different what's happening now because the emerging model is we're seeing tremendous growth for men and women in their 30s and 40s, in some cases their 20s, not because they've had an exit, because they have enough capital to want to invest in this very hot startup world. In the traditional world, you join an angel group. In the new world, you might form your own seed fund. You might invest by yourself or with a group, and you tend to be an active blogger, an active communicator. The networks, traditional angels were typically professional. The new networks for the newer, younger members of our groups often come from startup hubs local social networks. And the traditional angels were retired and they wanted to give back. The newer angels typically slide very fluidly between being entrepreneurs and being angels, and maybe sometimes being both. They're busy with work. They have young families and aging parents, so they're very, very time pressured. And as I said, they maybe have their own startups, but they've got multiple obligations well beyond work and angel investing. And this complicates how much time and effort they can spend as angels. A passion of traditional angels is often a traditional philanthropy. For newer angels, it's often a social cause, like climate change. The motivation of traditional angels is to give back, to mentor, and to make money, and to stay engaged now that you're retired. And the newer angels, much younger, they want to be a player and an influencer in a local tech community. They want to hang out with VCs. They want to build personal brands, and in addition, they want to make some money. So there's a lot of overlap, but there's a lot of newness in the new angel model. In terms of angels versus VCs, the big distinction here is that angels, or I like to put it this way, angels lose their own money. VCs lose other people's money. And the angel is a part-time investor, and the VC is a professionally employed full-time investor. The Band of Angels, my group, is the oldest angel group in Silicon Valley and the second or third youngest, or pardon me, oldest angel group in America. We've got about 170 people, most of whom have had very successful business careers, building companies not too dissimilar from the kinds of companies we fund. And we have a number of VCs like myself and attorneys who are also active in the ecosystem. We spend a lot of our time doing mentoring and have annual mentor days to meet random startups, giving them free advice, selecting a few to bring in-house and maybe invest in. In our 20 plus years, we've invested about $400 million. We've had 25% exits. I would say this is unusually high. 17 IPOs and 97 profitable M&A exits. So about a quarter of our deals have yielded real profit. We do about 20 deals annually. Our typical deal size is 250 to 500K. And if we syndicate with other angel groups or with VCs, as we often do, the deal size could be $1 million or more. We invest in every technology affected sector. Life sciences, including biotech, medical devices. We invest in software with the group I run. We invest in hardware of various sorts. We invest in energy. We've been active in space tech. But the key thing for us is it has to have a technology link of some sort. So we don't invest in restaurants. We don't invest in consumer goods by and large. There's got to be a technology leverage. We syndicate with everybody. Our typical individual checks that we write are between $10,000 and $50,000. Most deals get a 25K check from the individual investors. People make up their own minds. They invest individually, typically into a LLC, a limited liability company, so that the corporation in which we invest has one neck to choke and gets one check from us. But we are recorded individually as investors, and there's no requirement to invest in any given deal. Well, we'd like you to do at least one deal a year. Looking at startup capital in which we fit, it's a couple of, we focus on this slide first. We receive about 50 deals a month, 50 to 60. 8 of those deals graduate to be invited to a luncheon screening committee with the heads of each of our sector groups. The 3 best deals are presented at our monthly membership dinner. One deal has to be in the life sciences. And then we form diligence teams around people who care about that deal. And at the end of the day, 1 to 2 deals are actually investments after 1 to 3 months of diligence. So if you look at all of this, we fund about 3 to 4% of the deals we see. And our sources, probably a third of our deals come in off our website. people who didn't go to Stanford or Harvard, people we've never met before, our special interest groups like software or hardware. Deals come from our members, from our attorneys, from our network. Lots of deals from current or former band CEOs who've been happy with the way we deal with them. We've assigned members to work with incubators and accelerators in the San Francisco Bay Area. That yields deal flow. We've got partnerships with Berkeley, University of Santa Clara, and with Stanford, and we get deals that way. And we have a whole group focused on working with VCs to get the deals that are too early for them or the seed stage deals that fit us as well. So if you look at where angels fit in, there's a startup capital spectrum. Friends and family invest in the founder, help that founder get off the ground. Often, at least where I come from, incubators are the next folks who invest small amount of money, $75,000 to $100,000, to help the company build its minimum viable product. Most American angels invest later than the development phase. Where we come in is Series Seed, where there is a product ready to go to market, maybe some early sales, maybe a customer or two. And our focus is to allow the company to do go-to-market experiment and figure out the right markets, the right sales process, so they can start building a machine which is funded by early stage VCs and later stage VCs as the companies scale. The single most important metric most of us look at for companies that do have revenue is customer acquisition cost. How much does it cost you to acquire a customer this quarter compared to the last quarter? If it is typically static, it doesn't change, you're not ready to accelerate growth. But once your customer acquisition cost starts declining, that's when later stage investors put their foot on the gas. So again, what we want is successful experiments, and we often invest after the angel round into the early Series A or Series B rounds as well. Let's talk about risk and returns. Those are the two primary concepts for any business and any investor, but we hold them especially dear as angels. There's been a number of studies of angel returns, and the number I mentioned earlier, 2.7x, comes from the amalgamation of all of these. So typically, if you have a well-balanced portfolio and your hold is 5, 6, 7 years, you'll probably receive about a 2.7x if you have been lucky enough to have one of the winners in your portfolio. And this is the hard point. That as many as 80% of our deals fail to return the capital invested. And the top 10% of our deals typically return 80 to 90% of all the capital you'll get. So it's really important to be in that top 5 or 10%. And that's why diversification is super important. So again, 80 to 90% of the cash received by us comes from 10% or less of our investments. So the lesson here is build a portfolio, spread your capital risks. Another way of showing this is that if you have, let's say, 10 deals, 4 out of 10 will be complete strikeouts that will return no capital. 2 out of 10 will return the money invested. Another 3 out of 10 will return a bit more, maybe 2x to 5x. And home runs will return 10x or more, which is why an angel talking to an entrepreneur says, look, I need to look at your deal and believe that you have the capability of returning at least 10 times the money I've invested. Therefore, if you want to build a slow growth family business and you're happy to make a nice return every year, but it's not explosive growth, I'm not going to invest because I need to assume that you are going to be returning 10x. Now, again, most companies don't. But if we go in assuming we're only going to make twice our money, that's a terrible angel investor, even if it realizes that in fact, because we need a few home runs to make up for our bad deals. And most of our deals are bad deals. So the winners in our portfolio need to cover the losers in our portfolio. And again, another way of looking at this is one of my favorite charts from CV Insights. CV Insights is my favorite analyst firm for looking at the startup world. They examined around 1,100 seed funded companies, and they found that 14% of those after 8 or 9 years had exited, 3% had exited at 50 million or more, 2.7% at 100 million or more, 1.1 at 500 million, and under 0.5% became a unicorn. And so when I'm talking to CEOs and they tell me, well, of course we're going to become a unicorn, I say, yes, I hope you do, but less than 0.5% of companies that I meet do. So our goal is to make money even at these kinds of odds. And angels look at investments, hopefully with a very realistic eye. Not, oh, wow, we're going to do internet investing. We're all going to become billionaires. That's not a realistic assumption. So look at numbers, look at data like this to ground yourself in what the reality is for angel investings. So what kind of companies do or are capable of returning 10x? Biotech, healthcare, e-commerce, green financial technologies, and now AI. And so what gives you a 10x return? Disruptive technologies, large markets, fast-growing markets, disruptive business models, and capital efficient businesses, because the more capital it's invested, the lower your return will be. So always look for that 10x return. Right now, the hottest market is AI, which I believe is heading for a crash. But if you look what's happening with multiples, you can see how fast the expectations, how large the expectations are from investors. We'll talk about that shortly. So when we invest, what besides stock do we get? Well, we had the chance to add value as sounding boards, as connectors, as advocates, as people who introduce startups to customers, to employees, and we even often get to serve on boards. We get information rights, so we know what the heck is going on. We get some veto rights, so if someone wants to come in and cram us down, we at least get to choose whether that happens or not. We also get governance rights, board participation, observer participation, and these are really critical in doing good deals, because when a management team comes back and says, "Hey, we need a second round from you," you want to know what's happened. Have they met their targets? Have they met, are the assumptions changed? What's going on? And so information rights are really critical if you want to make the decision to invest again. What we need companies to do is to exit via an acquisition, which could be a private equity rollout or a acquisition by a strategic or an IPO. That's the only way we really can monetize our investments. So I mentioned risks versus rewards. These are the primary kinds of risks that we evaluate. Is the business model right? Things like, are the assumptions about how much customers will pay correct? Or will customers only pay a fraction? Is this the right team to build this kind of business? I once reviewed a great team for a ladies' handbag business. The problem was the team was great, but they were all Cisco engineers who knew about routing and collision detection. They knew nothing about the handbag industry. What about the market and the competition? Is this relatively a greenfield market, or do we have to disrupt Apple, Microsoft, and Oracle to get any market share? Is the technology protected? Is it unique? Is it hard to duplicate? Are there many ways companies can exit via IPO or M&A or private equity? Is there a mature governance structure? Is there a board? And if the board is a board of seasoned industry experts, or is it college cronies of the CEO? Are there regulatory issues, particularly in finance as well as in healthcare, that we need to deal with and track? This is one of the things that should have killed the Theranos deal right up front, because the regulatory issues were so tough that it was very likely that Theranos would fail to meet them, and when they had to meet them, they faked the data. So regulatory issues can kill companies. And then what are the risks for funding after me? Who's going to write a check after I do? I don't want to be the last guy to write a check before the doors close. So these are the formal risk categories. My organization has a whole series of courses called Angel University for people who are interested to go into depth in these sorts of issues. This is my eye chart for reminding myself and my colleagues how to evaluate deals. Are the deal terms appropriate? What's the valuation? Can the company justify it? What are the liquidation preferences, i.e., who gets the first money out if the company has any exit beyond an IPO? Do I have investor rights? And what about risks? What's the management risk, the exit risk, the capital risk? Can I confirm what management is telling me when I do my diligence and I call people that management knows? Can I confirm that they have picked the right competitors, that their technology is best of class, that they've managed to avoid lawsuits and are in legally good position? Is the business model correct? Is it the right market, the right customer? Do they know how to sell? What are they going to use funding for? And by the way, I always turn down deals when the uses of funding are to pay back an investor or a member of the management team. Our funding goes to grow companies, not to pay back previous sins. Once the company becomes profitable, we can talk about uses of funding. And then what's their capital model? What's their term sheet? How much money will they need to get to break even? Most importantly for me is, am I excited? Do I like the team? Do I like their mission? And each of us has a different profile of deals we like. Some of us like to invest in the last man standing in a sector. Some like to be the first in. Some of us like small deals at the beginning. Some like $15 million deals. Is the geography right? And what is this going to do to my brand as an investor? In one of the VC groups that I was a member of, someone brought in the best deal in our history. It returned the highest multiple ever, 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 and made us a fortune. And the investor was fired because he brought a gaming deal in that did really well, and the investors in the fund were concerned that we would get a strange brand since we focused on things like life sciences, not on gaming. Uh, and he was allowed to do that deal because we could each do a few deals a year that we personally believed in without the full permission of the group. So deals help create investor brands. So let's move on to deal process. So I will meet someone typically at a pitching contest or a meetup, a mixer for angels, VCs, and startups. I will like the deal a lot. And what I'll do is move to what I call bean stage, that is, invite the CEO out for coffee or have a Zoom meeting. I'll start talking about the deal to fellow angels in my group. When I think they're ready, we'll have them come in and pitch to us. We'll form an investor group of the 5, 6, 10, 15 members of the band of angels who like the deal, and we'll start doing diligence. And at the same time, as we learn things, we'll start our negotiation around terms, around valuation, around how much money we'll put in. We will make the CEO feel relatively comfortable by doing what's called soft circling. We'll go around the table and say, well, I'll put in 25K and Jim's putting in 25K and Nancy's putting in 50, and say, look, if this kind of works out, we can probably invest $250,000. We'll then confirm the diligence we've been working on, write a memo for the whole band of angels, and then finalize terms, and the finalized terms will be reflected in that memorandum. Get all the investors who want to invest to agree, and we'll close the round. This process takes 1 to 3 months, and it's not simply about what's the deal and what's the valuation. We're looking at risks, and we're putting together terms to mitigate those risks. Like, the CEO is a fantastic communicator. She is eloquent and charismatic. She knows how to sell, but she's never run an organization. And this organization needs to be run like a machine because it's acquiring customers fast, it's onboarding customers fast. We need a chief operating officer or a president to manage the operational side of the business, and we'll put that in as a condition in our term sheet. So we're looking for areas that we can correct. So we've talked about all these risks, but there's one thing that tends to sway angels around these risks. High performing team, a competitive moat. It's when it's hard to duplicate this technology, recurring revenues we love, high gross margins we love, getting to market fast, product development that's efficient, large markets, and compelling reasons to buy. These things help mitigate some of those other risks. But overall, if we believe that there is a high exit potential, let's say 50 times our money, 100 times our money, that may sway some members of the group to spend less time on diligence and more time on fantasy. But high exit potential can mitigate some of these risks. The earlier the company, the less mature the company, the lower the valuation, because the level of risk is very high. And as the company matures and de-risks itself, the valuation is going to go up because it's worth more to the investor. Things that reduce risk are multi-paying customers, third parties, that is somebody who's not your mom, who say that technology really works, intellectual property claims that can block others, great teams, understanding why the company is going to win. And again, we invest in companies, we don't invest in products. And we invest in management teams who do what they say they're going to do. So what do we fund? On average, we fund roughly 1 to 3% of the deals we see. This is true for every angel group I know and every VC fund I know. So do we fund great technology? Well, we do, but that's not enough. Okay. Do we fund great companies? Yes, but that's not enough reason to invest. What do we really invest in? Great deals, great investments, deals that are going to return 5 to 10 times our money in 5 to 7 years, deals where there could be one of the 3 or 4 market winners, where there are multiple exit opportunities and multiple sources of revenue. Those are the great investments. So naive angels who just join angel groups want to get enamored with technology. But unless the technology can turn itself into a great investment, and we do model our likely returns, we're probably not going to invest. So the perception is that angels are the first money in. And the reality is we're typically the first outside money in because we are preceded by friends and family and maybe an incubator or an accelerator. Again, we tend to invest when the company is about to go to market, not when the company is about to develop the product. A typical angel deal has a life cycle of anywhere from 7, 8, 9 years. In our first month, we're sourcing deals. We're negotiating deals in months 2 and 3. We're doing diligence. We're closing final negotiations, typically in month 3 of meeting the company. From months 4 to 72 or 84, we're hopefully on boards or otherwise monitoring the company. We're helping them with new financing rounds. We're measuring performance against plan. We're building competitive intelligence. We're helping them hire. And when we think it's ready, we'll form an exit committee and do all the things you need to exit the deal. So our work is not writing checks. I like to say our work starts when we've written checks, but real investors help as long as they can, as long as they're engaged across this full spectrum of activities. I want to conclude by talking about recent capital market trends, and then we'll open this up for some questions. We have been, as you all know, in startup winter globally. Exits fell to decade lows, and if there are no exits, investors stop investing because they don't see the returns. Exit multiples declined by as much as 50%. Startups stopped buying startups. Early stage funding fell dramatically. Today, we have a 20-year unicorn IPO backlog. If you look at the average number of IPOs per year, and divide that into the number of unicorns we have, it could take 20 years to clear the backlog. 2023 IPOs did not do well, and investors are not making money by increases in valuation from, let's say, Series A to Series B or Series B to Series C. Those step ups, as we call them, are low. And corporate venture capitalists, who usually around 25% of our combined markets, their dollars are down by 46%. And in 2023, $27 billion evaporated in 3,200 startup failures with VCs and angels. You can see through the end of last year, the continuing decline of money going into startups. There were 4 IPOs last year, and they're all trading below their IPO price. So that did not ignite markets. And if you look at 2023, these are some of the numbers I just mentioned: a 10-year low in exit value. 20% of our rounds were valued at less than the previous round, which means we all got diluted. You can see the kinds of trends here. And there was a 35% decline in US venture capital funding and a similar roughly 35% decline in European funding. So we were in the middle of these startup Hunger Games. No exits, not a very investor-friendly climate. VCs who follow us having a hard time raising money. Hint of recovery, but nothing positive happened last year. A growing capital crunch. As many as 51,000 startups globally searching for cash. Has been very, very tough out there. All of this is great news for experienced angels. It's a great time to invest. Valuations have been at a decade low. If you look at open source software, on-demand models for provisioning equipment, and a glut of cheap equipment, it's way cheaper to start a business today than it was 18 months ago. Management has more realistic expectations. The bubble is largely over, except in AI. And we've all had a history of creating winners like FedEx and Microsoft during down markets. Experienced angels can really make a difference. And because we've seen down markets before, we can help younger management team members know best practices and help them navigate these treacherous times. I will say I have written more checks this year than any time in the past 5 years. That's a great time to invest. I mentioned that valuations are now stabilized. These are traditional revenue multiples by which how we calculate valuation. That you're worth 4 times your revenue or 10 times your revenue. Well, during the go-go years of 20 and 21, companies were getting funded at as much as 40 times their revenues. Today, it's between 3x and 8x. So valuation multiples have come way down. What about angels? Well, as I said, bad times for VCs can often be good time for angels. We did not retreat to the safety of experienced entrepreneurs in the past 2 years. We've been investing more and more in first-time founders with new insights. So we did not become conservative. The purple is the percentage of deals that went to experienced founders, and the blue is those that went to new founders, first-time founders. We remained consistent. We invested in roughly the same number of companies we had in prior years. We invested in roughly the same number of deals. We invested roughly the same size deals. And while 2022 was a terrible year for VC exits, our median multiple of invested cash, that is, we invested $1, we got $2 back, was last year in 2022, the last year for which we have data, was an all-time high. For every dollar we invested, we got more than $1.50 back across all of our deals. And 86% were M&A, and we still were able to do well with M&A, even only 2% were IPOs. So think of angel capital as persistent capital. We didn't have a flight to safety. We didn't retreat from to safety. Our deals dollars were similar to prior years, and our angel group investing behavior remained constant. We did not freak out. VCs pulled way back from the market. We did not do that. So where are we now? We had two major IPOs this year. Reddit and Astera Labs have had a few since then. They were both successful IPOs. And if they lead to more IPOs, that's a great sign because now investors can make money. The new normal we have is there's AI, which is doing well, and everything else is not doing so well. I believe we are in an AI bubble. Overall, we've had fewer exits than we'd like. We're poised for growth. Valuations are stabilized until last quarter, and then last quarter valuations began rising sharply in almost every segment. At the same time,
Ron,
capital is really hard. We have
Ron, so it might be good to interject. There was a question in the chat about comparing the different sectors. They said, can you comment on how early stage investment might be different in life sciences and biotech versus some of the other
absolutely,
areas?
it absolutely is. I'll be talking about that in a minute. Um, uh, and life science in particular goes in waves. In the past, really since COVID, life science has been a favorite market. In fact, we've probably had more angel deals in life science than we've ever seen. Software remains strong, but when corporate buying is down, it becomes weaker. So we do have strong sector differences and geographic differences. Europe is investing much more in clean tech than we are in the US because the capital requirements of clean tech are so large that scared off angel investors who are pretty capital risk averse. But we are seeing if you do get funding, you're going to get more than you asked for, but it's going to be much harder to get funding. And VCs themselves are having a hard time raising money. So if you look at the valuations of different markets, off to the left, off to the right are artificial intelligence deals, the deals that AI is doing in I'm sorry, the AI is the gray bar, and that's been traditionally higher than the other bars. But if you look at generative AI, you can see between 2020 and 2023 where the valuations for early stage, mid stage, and late stage deals have gone. We've seen an explosion of from 92 million for later stage to $250 million median valuation, very much like the market as a whole in 2020 and 2021. These valuations are much higher than in any other sector right now. Overall valuations, as I've said, are rising, both early and late stage VC, and these are being mostly propelled by this expansion in AI deals. If you're not doing AI, it's still harder to raise capital, but we are seeing expansion in life science, and we are seeing expansion in any company that is meeting or exceeding its business plan. If you're not meeting or exceeding your business plan, you're probably having a decline in valuation. If you're meeting or exceeding your business plan, investors will beg you to take more money. So it's really a duopoly here. Companies that are not doing very well are not raising money, but those narrow spectrum of companies that are doing well are getting more than they asked for. And that's one of the reasons why valuations of companies that are being funded are expanding. But the volume of deals is still shrinking. So if you get funded, it's good news, but it's much harder to get funded, and that's continuing. And angels have begun to recover slightly as well. We're typically a pretty stable asset class. So to sum up, lessons learned. Angel investing is high risk, high reward. It's patient capital. Work with a mentor for your first few deals. Work with somebody in an angel group or friend to help guide you through all of the treacherous things that happen with term sheets, negotiations, due diligence. Learn from somebody who is a few years ahead of you. Diversify, because our top few deals return most of our capital, so be in a fair number of deals. We've estimated that it's in the range of 15 to 25 deals before you're appropriately diversified to hopefully catch a winner. Have somebody who is not a rah-rah cheerleader. have a devil's advocate on your deal team when you're looking at a company. Have somebody who forces you to look at all the risk factors and to satisfy the risks that some people have found. So angel investing can get quite wild if it's you only have advocates. So have a devil's advocate too. Team due diligence is more effective than doing it by yourself. You want someone to call management references. You want someone to look at financials, someone to look at the business plan, someone to look at the competitive landscape. And that's why team diligence, which we specialize in the band, is a much better model. Remember, your job is not what the VC's job is. Your job is not to write checks and to deploy capital. Your job is to build successful companies that benefit you and your family and your friends. And so our work starts when we write that check. And it's often the boring stuff, the legalese stuff like liquidation preferences, that determines if we get paid back or not. So don't ignore stuff that sounds boring. Don't fear down markets, and be engaged. One of our studies suggested that angels who visit their portfolio companies regularly, add value, help hire, return 3 times the money of passive angels. So that's all I have to say. I will quit sharing this and I'll make these slides available to all of you.
Ron, that was fantastic. I'm learning a lot, and I can absolutely, like, a part of the reasons I joined the Band of Angels were the ones you enumerated. A great network, ability to contribute and influence investing in business opportunities, as well as obviously the financial return. So this has been fantastic. We can open it up for questions, and just put the question in the
Yes.
chat, and then we can get to them
So
one by one.
Robert's question is a great one. Can I comment on how angel early stage investing in life sciences is different from investing in tech? The entire perspective is different. So for tech investing, an exit is an exit. An exit returns capital to investors. In life science, an exit is a fundraising event on the way to commercialization or acquisition. Uh, so sometimes angels can make some money, but the goal of an exit is to fund long term, particularly in things like biotech, where the capital required to get a company into the right position can be very, very large. It can be certainly can be in the tens or even $100 million. In some cases, the company has already invested $1 billion in life science research. If it's not an angel funded company, but that they spin that out into a technology that an angel group then invests in, that just a ton of money is going in. So the time horizon is much longer. Typically, there's an inflection point around year 4 or year 5 when the company has gotten its approval from the FDA to actually bring a product to market. At that point, the inflection point is: do we go all the way and invest in commercialization, that is, in the factories needed to produce our compounds, or do we get acquired at that point by a Johnson and Johnson, by a Merck, by a Pfizer? So the whole mentality is very, very, very different. Some VCs got out of life science investing because they wanted to build new funds every 3 or 4 years. And the time horizon for life science investing, is 8, 9, 10 years. So that's a primary thing. We are very capital intensive. So one of the things we look for, at least in the band, is capital efficient, not capital intensive, capital efficient companies that don't need tens of millions of dollars to get through the FDA process. And so that's a different perspective for us. But the time frame, the diligence is radically different. We're focusing on the issues required to get FDA approval. We're focusing on regulatory affairs. We're focusing on regulatory compliance in life sciences. And those are not issues for tech investing outside of fintech. So we could spend hours talking about that, but that's a great question. In terms of geography, before COVID, it was rare that an angel group would invest in a company that you couldn't get to in first gear. For those of you who remember manual transmissions. It was 50 miles. After COVID, I would say that a third of the deals that many angels are doing are national in scope. And some of us invest internationally. The problem with doing deals outside the U.S. Has nothing to do with the U.S. investors' lack of confidence or lack of interest in foreign deals. It largely has to do with legal issues. Under whose jurisdiction will the deal be done? What are our risks? What happens in down rounds? What happens when investors sue companies or companies sue investors? And apart from the Anglosphere, that is companies operating on US or British law, we don't have a lot in common with most of the rest of the world. One of the things I would like to be doing as chair of the ACA is finding better ways to create more legal common ground between various countries and the US so that we can do more offshore investing. The walls are beginning to break down, but by and large, most US investors invest in the US or Canada. I invest in the US, Canada, Australia, and Britain when I can, New Zealand. But that's because I travel to those places all the time, and I have angel groups or VCs I can work with who can safeguard my investment. So if you want to invest out of area, have a corresponding group, angel or VC that you trust, that can be the monitor, be the board member, be the observer, and kind of safeguard our interests in follow-on deal negotiations. Is that pretty clear?
Ron, and then part of the question on the geography was they were talking about types of entrepreneurs. So it seems like there's a tendency to invest in Ivy League alumni or California or New York. Is that right?
Yeah, well, that's first of all, that's where the startup hubs are that are large. That's where the deals are. Remember, I said that we do 3 or 4 out of every 100 deals we see. If you're in the East Coast or the West Coast, you are not deal starved. Because of the way capital flows and because of the way industries are built. If you're doing finance, you're probably going to want to be looking at deals that are coming out of New York or maybe San Francisco. If you're doing entertainment, you're going to be looking a lot at LA or New York deals. If you're doing logistics deals, you're going to be looking at a lot of deals in the largest Midwestern hubs like Chicago. And we follow industries. While we may create them, most of our industries are already where they are. So Delaware River Valley is great for pharma deals, as is San Francisco. Anyway, you kind of get the picture there. But the good news is that we're all syndicating. The ACA has launched a national syndication network. We can share deals. So if we've got a great pharma deal, we can offer that deal and you can participate in it. We may be leading it. You may have to trust us, but we may trust you in a logistics deal. So as I said, about a third of the deals we're doing now are for any individual angel group is likely to be more outside their region than inside their region. And so the walls are breaking down. But the way that happens is meeting your fellow angels, going to our annual conference, having conference calls with them, getting to know them so you build up the most important factor in investing, trust. So it's a very pragmatic guy. I rarely invest based on a great story or a great vision, and I rarely invest on the basis of a great demo. I'm much more concerned about the pragmatics of the deal. How much capital will they need from where? What kinds of investors are investing? What kinds of staff they need to hire? Because those are all the things that make or break companies longer term.
Ron, we're out of time, and I know there's a couple more questions. I may, in the interest of people's schedules, stop us here. We will be sharing the slide deck and the recording with everyone who attended and anyone who registered for the session. Ron, if people are interested in learning specifically about the Band of Angels, I don't know if you want them to reach out to you or Astley, but we can put that in the...
They should reach out to either one of us.
Okay.
Or you. They can reach out to any band member, because
that's fine.
What I do is I forward information on to Osley and say, start a a membership process.
And they can join and attend a session just to get a feel for it before they have to decide whether they become a member. Thank you so much, everyone, for attending. Ron, thank you so much for the talk. It was super informative, really helpful, and I think there was a really strong interest from the group. So hopefully we'll see some follow-up.
Can I just see a show of hands? How many of you might want to join an angel group or become an individual angel? Just we got 2, 3, 4, 5, 6, 7. That's great. It's been the most fun thing I've done in my professional career. So, but work with mentors, invest initially in stuff and where you can add to the diligence as opposed to being not knowing that market. It took me a long time before I was willing to invest in life sciences. Great investing, and I am rweissman@gmail.com. I'm happy to answer questions.
Thanks, everyone. Have a good day. Thank you, Ron. Thanks, Charlotte. Cheers.